A surgeon earning $400,000 sounds like enough to build a serious fortune. But here's what most high-income professionals don't realize: that $400K gross number is a complete illusion. Let me show you exactly what happens to that money. A surgeon earning $400,000 keeps roughly $210,000 after federal taxes, state taxes, and FICA taxes combined. That's a 47.5% tax hit right off the top. So before you even think about building wealth, nearly half is gone. Now here's where it gets interesting. A real estate investor earning $200,000 gross, which is half the surgeon's income, keeps around $150,000 after taxes. Wait, that doesn't make sense at first glance, right? How does someone earning half as much keep more money? The answer is deductions, strategic legal deductions. That real estate investor is deducting mortgage interest, property depreciation, repairs, maintenance, property management fees, travel to properties, and dozens of other expenses the surgeon simply cannot access. These deductions lower the investor's taxable income dramatically. So while the surgeon pays taxes on nearly $400K, the investor might only pay taxes on $120K to $140K of that $200K. This is the fundamental difference between earned income and business income. Let's run the 25-year wealth projection. Over 25 years, that surgeon retains $25 million in post-tax income. The investor $75 million. At first glance, the surgeon wins by $5 million. The surgeon kept more cash. But and this is critical, this is where most high-income professionals miss everything. That $75 million the investor keeps isn't just sitting there. It's compounding differently than the surgeon's $25 million. Here's why. The investor's lower tax drag and superior deduction arbitrage mean that every dollar compounds faster. The investor isn't paying 47.5% tax on capital gains from their rental properties. The investor is using depreciation recapture strategies, 1031 exchanges, and bonus depreciation to defer taxes for years or decades. Meanwhile, the surgeon is paying ordinary income tax rates on everything. Then capital gains tax on top of that when they try to invest their $210K annual surplus. So by year 25, the wealth gap doesn't just close, it flips completely. The lower earner wins. The $150K income investor has built more actual wealth than the $400K surgeon. The investor might have $12 million to $15 million in net worth. The surgeon, maybe $8 million to $10 million. That's a $4 million to $7 million difference. And the surgeon earned twice as much over 25 years. This is the tax trap that costs high-income professionals $500,000 to $1 million in compounded wealth over a career. Sometimes more. Most of them never see it coming because nobody breaks down the actual numbers. They see the gross income, they feel successful, they work harder, earn more, and don't realize they're running on a treadmill that's getting faster while they move backward relative to their potential. Now, there's a third player in this game that most people don't talk about. What about the entrepreneur who earns $200K gross but structures it as S-Corp income with a salary component? That entrepreneur might take a $90K W-2 salary and $110K in distributions. They avoid self-employment tax on the distributions entirely. That's roughly $15,500 in FICA taxes they don't pay. Combined with business deductions, that entrepreneur keeps around $155K to $165K on $200K gross income. So they're actually outperforming the real estate investor slightly, and they're definitely crushing the surgeon. This is the exact breakdown of how gross income becomes kept wealth, which professions rank highest by actual net wealth, not salary, and the 3 decisions that high earners miss. First decision, most high earners never shift from W-2 thinking to business owner thinking. They're optimizing for the wrong metric. They chase gross income when they should be optimizing for tax-efficient net income and asset accumulation. Second decision, they don't layer deductions strategically. A surgeon could invest in real estate on the side, capture those deductions, and immediately improve their wealth velocity. But most don't because they think their salary is the wealth-building vehicle. It's not. Third decision, they compound their money at the wrong rate because they're not tax planning backwards from their goal. The real estate investor is literally building their wealth plan around tax efficiency first, income second. The surgeon does it backwards. So the question isn't how much do I earn, the question is how much do I keep and how fast does it compound? That's the game that actually builds lasting wealth. And that's why $400K surgeons often build less wealth than $150K real estate investors who actually understand the rules.